Hi everyone, welcome back. If you are an audit professional who is working with a US listed client, then SOX is a part of your life. There is absolutely no escape from it. But let's be honest, a lot of articleship students, freshers, may not have the required background about SOX and directly jump into SOX testing without understanding the nuances of what is a SOX control, how is it different from a non-SOX control, and how they can actually add value to a SOX audit or tie it back to the bigger picture of SOX compliance. So don't worry, in this video we will cover everything from scratch. We will be covering what is the SOX Act, why was it introduced, what are some of the key provisions, whom all is SOX applicable to, what are SOX controls, and ultimately how can you perform a SOX audit and add value to the client you are auditing. So let's begin. The Sarbanes-Oxley Act, also called the SOX Act, was introduced in the United States in 2002 in response to various corporate accounting scandals that completely shook investor confidence. A few of those names you would have heard are Enron, WorldCom, Tyco. Now, take for example Enron. This was perceived to be a very successful company, but what was really happening? Enron was using accounting loopholes to hide billions of debts from its balance sheet and was inflating its profits. So over time, it became bankrupt and it had to file for bankruptcy. Lots of employees lost their jobs, a lot of people lost their savings, and eventually Arthur Andersen, which was the accounting and audit firm, one of the big 5 audit firms which was auditing Enron, was also suspended and had to be shut down. So that's the magnitude of impact of fraudulent or materially misstated financials, and thus SOX is very critical not just to ensure compliance but also to enhance public confidence. And SOX Act was introduced mainly for prevention of fraud, for improving quality of financial reporting, and imposing accountability on the management to ensure that the financial statements are accurate. So let's see what are some key provisions of the SOX Act. So on the screen, you can now see some of the important sections of SOX Act. So section 302 states that the CEO and CFO must certify at the end of each quarter and at the end of the year that the financial statements do not contain material misstatements, they are true, they are fair, okay? And they also assume responsibility for designing internal controls of financial reporting. Section 404 requires that the management will not just implement and design internal controls but will also test and evaluate them, and also requires an external auditor to perform an independent assessment and attest these internal controls over financial reporting. And lastly, section 906 states that if there is a fraudulent certification, if there is a non-compliance, then there can be criminal penalties on the CEO or CFO. Okay? So the companies are also required to file certain forms under this act, and this includes Form 10K, 10Q, 20F. So based on whether the company is a domestic company which is listed in US or a foreign company listed on the US Stock Exchange, the kind of forms vary. So the details of the required forms and what they contain have also been mentioned on the screen, so you can go through. But the key thing to remember is that SOX requires the management to attest on the accuracy of financial statements and also perform an assessment of internal controls. Let us understand what is the applicability of SOX. SOX is applicable to all public companies that are listed on a US stock exchange, irrespective of whether it is a domestic company incorporated in US or if it is a foreign company that has listed its shares on the US stock exchange. It is also applicable to subsidiaries of US listed companies as well as to vendors of US listed companies if those vendors have been outsourced services which impact the financial reporting of the company. Okay, so it is not applicable to private companies as such. However, if a private company intends to go public through an IPO, then SOX will become applicable for that company too. So on the screen, you have different company types and examples so that you can easily correlate SOX applicability. A lot of times, freshers often ask that, hey, the company is an Indian company, then why are we still testing for SOX compliance because SOX is a US based act? That is because the Indian company would have its securities listed in US, and that is why SOX is applicable for that company. So now this makes it very clear for you to understand applicability. Now let's understand what are internal controls over financial reporting, also called as SOX controls. controls. These are the controls designed to prevent or detect material misstatements in financial reporting. So if we have financial statements, that is our P&L accounts, balance sheet, notes to accounts, cash flow statements, we want to ensure that these are accurate. So the controls that help to ensure the accuracy of financial statements are nothing but ICFR or SOX controls. For example, a control to ensure that the revenue is recognized correctly, appropriately, in the right period. That would be an ICFR control. Now, how is this different from other controls, which we also call as non-SOX controls? So the other controls are those which support operational or compliance risks or certain non-material financial risks. For example, a control to perform background verification before recruiting an employee, or a control in procurement which involves taking vendor satisfaction surveys, or under inventory management if there's a control for inspection of the goods received. All these are essential, they are important, but more from an operational purpose and not from a SOX compliance purpose. They do not directly affect the financial reporting, and hence these are non-SOX controls. So how do you practically assess if a control is a SOX control? So whenever you're in doubt, you can ask yourself these 3 questions, and if the answer to any of these is yes, then the answer is that it is a SOX control. So what are the 3 questions? First, does the control relate to input into financial information which is used for financial controls? Now, for example, if there's a control for ensuring accurate processing of journal entries, so is it related to input data? Yes, because your journal entry is going to be an input into your ultimate preparation of your financial statements. So controls around journal entries are controls which impact the financials, and hence these are SOX controls. On the contrast, if there's a control for tracking of employee training records which feed into employees' performance appraisal, that is not going to be a SOX control. It does not affect your financial statements. Second, does the control affect financially material accounts? So consider this. If there's a control for revenue recognition, so revenue is in any case going to be a material financial statement line item. It's a material account. On the contrast, if you're looking at petty cash reimbursement, that may or may not be material. So based on materiality, if the control is impacted a financially material account, it will be a SOX control. And third, does the control affect any system that feeds into financial reporting? For example, if there's a control that relates to access management, okay, access is restricted to sales module. Now, sales module will impact your revenue recognition. If you access the sales and book sales there, it can impact your revenue. It can impact your financials. So though it is a system control, it can impact financials, and hence this would be a SOX control. So this is how you assess the applicability of a control as SOX or non-SOX. Also, in organizations, you will find that there are different classifications of controls like ELCs, PLCs, IT controls. So let's see that also. So what are entity level controls or ELCs? Now, these are controls that set the tone from the top. They lay down the control environment for the organization as a whole. So example could be having good policies, having a code of conduct, having whistleblower mechanism, having corporate governance, having audit committees and other committees in place. So are these SOX controls? So the answer is, in most cases, these are considered as SOX controls because they lay down the control environment or governance of the organization. Now next, coming to process level controls. So the kind of processes in an organization depends on the business of the organization. So typically in a manufacturing company, you will have order to cash, procure to pay, HR and other such processes, right? So now how do you identify which control in the process is actually a SOX control? For that, you need to consider the 3 questions that we already saw. So ask yourself these questions and you'll have your answer. Lastly, for IT controls, other than question 3 that we already saw, you need to also ask whether the applications are being used for processing financial information or for processing data which is being used for financial reporting. then in that case it becomes a SOX in scope application, and those controls which are affecting the confidentiality, integrity and availability of data in these applications, all of these would become SOX controls. So I hope this helps you to identify practically which controls are SOX in scope. So to understand the whole SOX audit process, let's also briefly touch upon the 3 lines of defense framework. So what does this mean? So in any major organization, we have 3 lines of defense, the first, second and third line, and each of them have distinct responsibilities when it comes to SOX compliance. So the first line comprises of all the control owners whose job is to identify the risks in the process and then design and implement SOX controls so that they can mitigate those risks. Now the second line is a governance function. Now the job of second line is to review the work done by the first line, to review the design of the controls and the operating effectiveness of the SOX controls, and then identify if there have been any deficiencies and also take steps to remediate those. So they will work with the first line to identify if there needs to be any action taken by the first line. And lastly, we have internal audit. Now this is an independent function which reports independently to the audit committee. So it will evaluate the effectiveness of the overall SOX governance or SOX compliance program that has been defined in the organization. Okay, so the kind of testing that you do when it comes to SOX depends on the mandate, which line of defense you are part of. Okay, so typically most people who are in the Big Four, when do they come in the picture? It is when the SOX testing has been outsourced to them. So in that case, their job is to perform the test of design, test of operating effectiveness, and then identify the deficiencies and submit their report to the client. So it is on the basis of this SOX testing that the management will be able to perform a self-attestation. So if you remember in the earlier section when we saw provisions of SOX, we saw that the CEO and CFO are responsible to certify that the financial statements are free from material misstatements, and that is only possible after the SOX testing, which is done by the second line. So practically how it happens, in a large organization there will be so many locations, entities, functions. So all the first line control owners will do a self-assessment. So they will independently perform a self-assessment and derive their own conclusion whether the control is operating as intended or not. And then the governance team will do an independent evaluation. So this could be in-house or outsourced to a Big Four. This report is what goes to the CEO, CFO, to the management, basis which the final certification is done and Form 10Q, Form 10K are filed. Okay, and the independent internal auditors report goes to the audit committee. Other than this, we also have external auditors. So if you are a Big Four who is an external auditor and is involved in SOX compliance, SOX testing, so it is important to note that yes, as per SOX, even the external auditor needs to attest on the appropriateness of the internal controls over financial reporting. But instead of doing an overall testing, what they will also do is rely on the work done by the internal teams and then form an independent opinion and express their opinion. So that is why it's important to understand which function you are a part of and what is the mandate or responsibility of that function, so you can take the right steps for SOX compliance accordingly. So always check for the mandate defined by your client or your organization. So now, assuming you're part of the second line of defense or an outsourced service provider hired to do the SOX testing, then these are the steps that are required to be performed as part of SOX audit. So the first step is risk assessment. Now, what is risk assessment? What is risk? It is the possibility of something going wrong. Now, risk is always a function of likelihood and impact. What is the probability or likelihood of something going wrong? And what could be the impact of it if it goes wrong? So based on this, the risk scoring is done, and then the risk is classified as either high, medium or low. So this is important because this will help an auditor to focus on areas of high or moderate risk and then do targeted efforts in terms of SOX testing. Now, second, when it comes to materiality assessment, so materiality is defined typically as a percentage. For example, it could be percentage of profits, say 5% of the profit before tax. So in that case, if there's any error which has an impact greater than 5% of the profits, then it could be a material impact. And this is important for auditors because they will also focus efforts on those areas which can have a material impact on financial reporting. So if you want me to make a detailed video on risk assessment and how materiality assessment is done, then don't forget to drop a comment and I'll be happy to upload videos on that topic. Now the next step is identifying the SOX controls. So SOX controls, or in general any controls, these are defined and implemented by the first line, but the second line will assess and evaluate and test these controls. So we've already seen how can you as an auditor determine which control is a SOX control. So we've covered that in detail with examples. Now we also do a fraud risk assessment because it is possible that though there are controls in place, there may be a fraudulent activity, and this happens when the controls are bypassed or there's a fraudulent intent or there is collusion among employees. So that is why fraud risk assessment is done to identify such risks and focus on those controls, test those controls without fail, because those could have a high impact on the overall financial reporting. Documentation comprises of your process charts, narratives and all. So it is important for the organization to demonstrate the documentation of the controls that are in place. So now the meat of the work is in terms of testing of controls. So how does that happen? So there are two phases here. First is design testing and next is testing of operating effectiveness. So when you do a test of design, you're basically testing only one sample. You're testing one control sample from the start to the end. So the intent is to see the nature of the control, to see how it has been designed, how is the control environment. We are not going to test whether the control has been performed consistently over a period of time, but we are just taking one sample and either through discussion with the stakeholders or through observation or through reperforming the control independently, we do a design assessment. And some of the things which are considered in design assessment are whether the control is being performed by the right people. Are the people having adequate knowledge? Are they competent? Okay, and whether the control's frequency is adequate. So if the control is being performed weekly, is that enough to mitigate the risk, or is it required to be performed daily? And then what is the nature of the control? Is it preventive? Is it detective? Is it manual? Is it automated? So that helps to decide the testing effort also, and also whether that attribute is enough to mitigate the risk. And also we check whether the control can be overridden, whether the information used in performing the control is appropriate, and so on. So after that, we will conclude whether the control is designed adequately or not. Once that is done, we move on to test of operating effectiveness. So what is that? Here we do sample testing. So we pick samples over the audit period and check whether the control has been consistently performed as intended over a period of time. So the number of samples selected varies based on the type of the control, whether it is manual or automated, and also depends on the frequency of control. So if it is automated control, we always test one sample. So one sample is enough to conclude on design as well as operating effectiveness, because it is automated, so it has a lower probability of going wrong, right? Lower risk. Whereas if it is a manual control, we will pick samples, and based on the frequency, we pick samples. So higher the frequency, higher is the number of samples required to be tested. And if you remember, there's a separate video I have made which talks about the risk and control matrix, and that is how it works. So the auditors will have a detailed risk and control matrix where they define the testing procedures, form testing of these controls, and once that is done, they will document the results of the testing, so whether there are any findings, and the findings have to be further assessed into whether it is a control deficiency, a significant deficiency, or a material weakness. Also, it is important to note that while the second line goes ahead and tests the controls as defined by management, it has the authority or the freedom to challenge the existing controls and recommend any new controls which are missing based on the discussions or walkthroughs held with the process owners or control owners. So a control deficiency is a small issue in how a control works, but it is unlikely to impact the financial statements. For example, let's say there was an isolated instance where the three-way match between PO, GRN and invoice was not performed. Or let's say there's a control that requires that all expense reports must be reviewed and approved by 15th of the month, but instead they were approved by 17th. There was a delay of 2 days. Now, both these cases are isolated instances. There's no real impact. So these are minor deficiencies. So these are control deficiencies which do not impact the financial statements. Now, let's say there's a significant deficiency. So what does that mean? It's a bigger weakness, which means there could be errors, but it is not likely to cause a material impact on the financial statements. For example, there's a control for segregation of duties. So we noted that this control was compromised. There was a person who could create, approve invoices as well as make payments. But despite this error, there was no fraud, there was no misstatement, there was nothing that went wrong. Yes, this is a significant deficiency, but it did not lead to a material error. So in this case, it will be reported to the audit committee. There will be steps taken to, of course, rectify this, but it will not be reported to the public. Now, a material weakness is a very serious issue. It means that material errors could likely occur and impact the financial statements. For example, an error in revenue accounting, or if revenue was deliberately overstated. So in those cases, it is a material weakness and it has to be disclosed in public. So the external auditor will give an adverse ICFR opinion if this is not fixed. After assessment of the deficiencies, the will call the control owners and obtain the remediation plans. So these are nothing but the action plans or action items that will be initiated by the control owners to fix the gaps identified during the SOX testing. So they will also commit to a timeline for the remediation plan. Thereafter, the SOX team, the testing team, will prepare a report to be shared with the management, and this report will contain their overall summary. What was the testing period? What were the number of controls that were in scope that were tested? Out of which how many passed, how many failed? What kind of deficiencies were identified? Were there any thematic root cause that led to these deficiencies? And then what is the status of remediation plans? So all of this would be summarized in a report format for the management to review. So this is how the SOX compliance life cycle works, including the SOX testing. Now, practically in an organization, it works in phases. So that at the start of the year, a SOX scoping is done, which is done based on materiality. And thereafter, timelines are defined for completion of management's self-assessment, which is done by the first line, wherein the control owners are certifying and assessing their own controls. And then there's also timelines for completion of SOX testing. So the testing happens in 2 phases, and the idea is so that if there are any gaps identified during the first phase, then they will be remediated as early as possible before the end of the year, or at least by the completion of the second phase of testing, so that it cannot adversely impact the overall opinion in the SOX report. I hope you found this useful, and do not forget to subscribe to stay updated on more such informative videos.